Good morning, everybody. Today is the fourth day in the month of February 2022. My name is Heritage Adisa, market analyst at HotForex. And quickly, as usual, we check through the markets, see what the dominant sentiment is, see the opportunities, and then how we can take advantage of it. But please remember that this is just a communication material, and nothing in this communication should be considered as investment advice or investment recommendation. Users acknowledge that investments in FX and CFD products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which users are solely responsible and liable. Now, what we have this morning in terms of the overall market environment is another mixed start to the day. Yes, you look across board. This I wrote here earlier. I said markets take a breather from yesterday's volatile trading. Now, yesterday we had a lot of moves, exciting moves as well in the market. First of all, we had ECB, that's European Central Bank, as well as the Bank of England, the rates meeting. And yes, despite both of them coming out more hawkish, or let's say it like this, from the BOE statement, they hiked rates, and then there were even almost half of the members wanted even more hikes, right? They hiked by 0.25%. About 4 of the 9 voting members wanted about 0.50% hike, right? That was really hawkish for the British pound. But it wasn't long after that we had, for the downside, the upside that we saw did not last so long, and we had downside from it to continue up. On the ECB side, the statement itself was verbatim compared to the last statement that they had. It didn't really change anything in terms of rates, language, and all of that. But when we had the press conference, they came out being overly hawkish. Number one, um, fears on inflation have become very, very, very serious for the European Central Bank, right? They've said now that inflation risk are now tilted to the upside. This is a phrase they've not said in years, say 10 years, 9 years, thereabout. And then that was obviously, a very serious one for the markets. And they also give more or less generally open the door for a possible rate hike even in this year, 2022. And then first of all, yes, they need to finish or taper or stop buying assets first, and then we'll talk about rate hikes. But that's what market took from that. And we had the euro jump across board against everybody, really. And he's still keeping those gains in today's session, right? We also had Amazon, right? Amazon yesterday evening as well. We also had earnings release, right? And earnings release, first of all, we had Meta, that's Facebook, a previous day, which really pushed markets negatively because we had earnings miss on Facebook side, and then markets were down back of that. Now, yesterday night, we also had Amazon, but this time around, they beat earnings, right? Printing earnings per share of about $27, right? Against market expecting just $3.58, right? And this was on to an investment they had in an electric car company, Rev, Revan, right? So that was the reason why we had that strength or one of the reasons why Amazon's earnings, general revenue really jumped up so much. And this has kept equities gently supported so far. Strong from yesterday's session, but in today's session so far, trading mostly flat, which isn't, giving us more of, strong sentiment to hold on to. So equities trading flat. Yes, a couple of things yesterday, but all of those moves yesterday, I've seen a little bit of simmer down. And ahead of key job data released for Canada as well as the US, it wouldn't be, so much of a surprise if we keep seeing tentative price moves heading towards those economic data releases. On the FX side, mostly mixed as well. We have Euro keeping the gains, but then CTF is also leading, also alongside the Euro in terms of strength. On the other hand, we have AUD lagging, we also have JPY lagging, and these moves still are still very marginal, right? So let's quickly look at what the different asset classes are saying, what to expect from the unemployment and jobs numbers for US as well as Canada in the day ahead. Now, starting with the equity space. Yes, we've seen, from Facebook Meta downside that we saw the previous day. We also saw a continuation to the downside, even in yesterday's session, as central banks even came out being more hawkish generally, right? But late yesterday, we had that Amazon, upside, which was good. But even with all of that, it's really simmered for the day. This is the 4th of February, and we've not really gone anywhere just yet. Now, one thing I want to also call our attention to is over the last couple of sessions, we've started the day really flat. Right, this was yesterday. If you go back a bit, on Wednesday, we also had a similar start. On Tuesday, we had a similar start flat. On Monday, we had a similar start flat. So this doesn't really mean that the rest of the day will continue being flat. Although, because we have job numbers, key events later in the day. We could see this continue till we get those numbers, but obviously we should expect volatility heading into those numbers. We'll talk about what to expect later during the course of this video. Right now, that's really the story across equity space as well. We had a jump yesterday's session, but really continue to trade mostly flat so far in today's session. For the VIX, right now, yes, we had that initial spike to the upside. Right, in yesterday's session on the back of central bank, hawkish tilt yesterday, but in today's session as well, we're also keeping very flat so far, and it's also something to also watch out for. We may keep being flat till towards the economic data release that we have at the start of the US session later in today, right? Apart from that, oil has been an interesting one to pay attention to, and then we talked about oil being in a range for a while, a couple of sessions back. Even we still said it yesterday, we said it on Wednesday, that oil has really remained in this range. But because it's remained above, it's not been able to break back below the $85 per barrel level. And then with the tensions, even though they had started to simmer down, tensions with Russia and Ukraine, and then even supply constraint, which has always been in recent time been creating tailwind for oil prices. We said, yes, we needed more catalysts for us to see this push higher, but it wasn't long yesterday's session where we saw that gentle spike. I wouldn't even call this gentle, solid spike to the upside in yesterday's session, right? In terms of fresh catalysts, really, there wasn't so much, but oil prices keep being elevated. And now we're heading towards the $90 per barrel level. Now, where we even currently trading at is really the highs for a lot of years going back. I mean, almost a decade. If you look back, the last time we were trading around this level was way back in 2013. Now, what markets are expecting is, yes, in terms of strength for oil prices, yes, it remains, no doubt. But really, at these levels, we're starting to see, some form of you're getting really to lofty levels. And then in as much as markets are calling for it to get to $100 per barrel level, which is still far off, right? In the meantime, all of this upside has been strong, and it wouldn't really be a surprise if we get some form of pullback on the back of this. But still, tailwind, that's upside for oil prices, are still very much in play. As long as the tensions keep being there, as long as supply constraints keeps being there, right, it would still continue to push oil prices higher, even though we have some downside in terms of profit taking. Remember, it's Friday. We could get that. But after that, obviously, you expect further upside. And one of the major worries here is rising energy prices generally, oil prices generally, right, is one of the major reasons or major causes for inflation that central banks are really worried about. From the ECB, from Lagarde's speech yesterday as well, she mentioned oil prices and energy prices rising as one of the major reasons for the spike in inflation, almost accounting for the entirety, right, of inflation rising higher. So the fact that this continues to push higher is really not that good for equities, because as it keeps pushing higher, it's taking general inflation along with it. And when that happening, or with that happening as well, it doesn't bode well for central banks, because they want to tighten to try and keep inflation back on the wraps, and it's bad for equities. So we are in a point in markets where oil prices and equities could be behaving in totally opposite manners, and I've explained why that is the case. So very key to still pay attention to on the back of that. If increasing production from OPEC, right, about 400 OPEC plus OPEC GMC by 400,000 barrels per day could not push oil prices lower, right? Then you need to also be very watchful. Or bulls should love this, but we need to also be very careful at the highs that we are currently approaching so far. The dollar index is another interesting one. All through this week, we've seen solid downside in the dollar, right? The strength in the euro pressured the dollar index even more in yesterday's session, right? I'm still not giving up on longs in the USD because of the Federal Reserve future action. But what we need to also be watching out for is this key support level that we're trading into, right? Right now, you look at this level, it was also key support trend line going back to middle of last year. We look at it, it was tested around May as well as June in 2021, came very close in September as well as October, again in January, and now we are back trading around that level. I would love this level, bulls would love this level, right? But we'd like to see what other central banks do. The reason why the dollar has enjoyed a lot of strength in recent months has been the divergence between the Federal Reserve as well as other central banks. Other central banks like the ECB were not as hawkish, Other central banks like the RBA were not as hawkish as well. Right? But now with all of them trying to catch up in terms of the hawkish nature, that divergence might really slow down. Right? So there's also that to just pay attention to so far. In terms of currencies and currency pairs, yes, the euro keeps its strength so far with equities not doing much, being pressured so far. We've seen currency pairs like Euro versus NZD push higher, starting from yesterday's session and even continuing in today's session, right? If we continue to see equities trade lackluster, I expect the strength in Euro to keep being there for the time being. And then we could look at this potential level as another one to pay attention to. We've cleared out the highs of Asia yesterday, as well as Monday, Tuesday this week. And now we could look out for it as further, potential retest for further upside. Although in today's session, though, we've really come back to retest this 1.715 and we've pushed higher, right? We could look at that also as another potential pullback level, holding on to the moving average we have on this particular time frame, and then we could look for other upside on this particular one, right? You look at currency pairs in terms of strengths and weaknesses, like I mentioned, there really isn't so much in terms of the move so far. Markets are trading very tentative. And then until we get the job numbers for the US, right, we might not get so much in moves. Now, what do we expect from those numbers from the US, right? We're expecting job numbers, right? A non-farm payroll, we're expecting even unemployment rate for the US, also expecting numbers for Canada as well. Now, from this, first of all, markets are expecting lower prints in terms of new jobs added, about just 150,000 new jobs added, right? Worries from this has been, let me say, compared to the previous print, which came out at almost 200,000 new jobs, we're expecting lower jobs added to the US economy. Concerns have been raised on the back of Omicron, worries for the month of January, even late December are still spilling off. And then you look at numbers that precede US unemployment data, numbers like ISM manufacturing and services. For ISM manufacturing, we had flat numbers. If it does go back a little bit, a couple of sessions, okay, all right. For ISM numbers for this week, we had flat numbers, really not so much in terms of changes. Yes, services was better, but just by tiny margin. ADP though, I think we had ADP. I want to see if we can get ADP. Okay, like I said, services was a little bit better, but not by so much. We had ADP job numbers for this week. All right, let's go to this week. So we'll just look at it fully from this particular point. All right, so we had ADP numbers for the US. Let's just look for it. ADP Tuesday. All right, when was that? Job numbers for the US. ISM Wednesday, we had ADP. I'm trying to look for the ADP numbers. Good. ADP numbers, job numbers. Usually it's a pre-NFP number, and then we had it, and then it was way dismal. And markets were expecting 207,000 new jobs, which was way lower than the previous month that came out at 776,000 new jobs, and it printed at way negative at minus 330 thousand jobs. Now we could argue that this has not really been a solid in terms of correlations with the new NFP print, but obviously it's one to worry about is also still job numbers for the US. Now, NFP that we're having in today's session, right? If we pay attention to it as well, we should pay attention to it. Markets are expecting weaker numbers, and if it comes out even more dismal, it could really put the nail in the coffin for the dollar for this week. Currently, the dollar is already down. Let's see. The dollar index already down about over almost 2% for the week already. So this is also something to worry about. But if you get weaker numbers, right, it could see Euro USD push even higher, rather. You could see Euro USD push even higher, but obviously better numbers could see some form of pullback on this particular one. I'm worried about buying at the highs, buying Euro at the highs so far. I think I'm heading into the weekend. I feel like with NFP coming up, I think it's something to still be very concerned about until I'm patient about. Going into next week, right, we'll have to see how the days play out. In terms of central banks, yes, the ECB are now more hawkish, the BOE more hawkish, right? The BOC disappointed, but oil prices keep, tailwind for the Canadian dollar. The dollar, yes, this week has seen a lot of downside, but right, the Fed has still been very hawkish. We need to pay attention to what they say going forward, to know where we are at. For the RBA, we still have that to watch out for going into the week. So yes, the rounding of the week, we could see profit taking, we could see pullbacks. That should be very at the top of our minds. But obviously with NFP, and then for Canadian job numbers, also another interesting one to pay attention to. Now, numbers are also expected to be very dismal, right? Compared to last month where we had a plus 54,000 new jobs, we're expecting a weaker 117,000 new jobs lost rather, right, for the Canadian economy, right? In as much as that is also interesting, right, unemployment rate is expected to also increase. So this is really bad for the Canadian dollar. And if this comes out even more dismal, it could be bad for the Canadian dollar. But just one thing to pay attention to, because oil prices have kept being strong, so that might really keep us, in the balance on that particular one. But obviously the numbers will be interesting. I'm not really looking in a hurry to jump into so much. The overall sentiment is mostly mixed. Like we had written down earlier, moves are still very, very much marginal so far. I will pay attention to job numbers for the week, but I wouldn't still look to jump into the print just as we see it, and then we'll see how the day plays out going forward. So we're going to leave it at that for now. Thank you very much. If you have any questions, please do not hesitate to ask, and we'll always do our best to help. Thank you. Do enjoy the rest of your trading session. Goodbye for now.